Hello there, and welcome. If you're self-employed or a freelancer here in the UK, you probably know that feeling, that little knot of anxiety that can creep in when your January tax bill is due. Well, today, we're going to unravel one of the most confusing parts of it all, the self-assessment balancing payment. We're going to make it crystal clear for you.
And we're able to break all of this down thanks to the fantastic tax experts at My Tax Accountant. They've arranged and developed this entire guide so you can rest easy knowing you're getting top-tier, straightforward information to help you get a handle on your taxes.
So let's be real for a second. Have you ever logged into your HMRC account in January, seen that final number you owe, and just felt your stomach do a complete backflip? If that's you, trust me, you are definitely not alone. It's an experience that connects thousands of us every single year.
And that really gets to the heart of it, doesn't it? That dreaded January bill. It's the moment of truth. And for so many people, it's a moment of pure shock. The number one question we hear is, why on earth is my tax bill so high? So let's unpack that.
You know, this feeling of shock, it isn't just you. It is a major source of stress for freelancers, sole traders, and pretty much anyone self-employed across the UK. You work incredibly hard all year. You try to put money aside and then bam, this huge number just appears. It can feel really overwhelming. But here's the good news. It's almost never a mistake. It's usually just a misunderstanding of how this system works, and we're going to clear that up right now.
I bet this sounds familiar. You make a payment in January, you make another one in July, and you're thinking, great, I'm all caught up, or at least you're on track. So when another, often much larger bill lands the next January, it feels like they're asking you to pay all over again. This is the exact confusion we're about to demystify.
Okay, let's dive in and finally get rid of the jargon. There are really only two key phrases you need to get your head around: balancing payment and payment on account, which you'll often see HMRC shorten to just POA. Seriously, once you understand what these two things are and how they fit together, the whole system is going to click into place.
So first up, the balancing payment. And honestly, the best way to think of it is exactly what its name suggests. It is the payment that balances the books with HMRC for a tax year that's already finished. See, after the tax year ends and you filed your return, HMRC knows exactly what you earned and exactly how much tax you owe. The balancing payment is just the difference between that final, real figure and what you've already paid in advance. It's the last piece of the puzzle that settles your bill for the previous year.
Now, what's really interesting here is how this separates the past from the future, and this is so crucial. Payments on account, or POAs, are all about the future. They are advance payments that HMRC asks for, and they go towards the tax bill you are building up right now. And how do they guess what that will be? They just look at your last bill. A balancing payment, on the other hand, is all about the past. It is the final true-up for the tax year that has just finished. So POAs are looking forward, the balancing payment is looking back.
So, you might be wondering, does this even apply to me? Well, here's a quick pro tip for you. You generally have to make payments on account if two things are true. First, your last self-assessment bill was over £1,000, and second, less than 80% of your tax was collected at source, like through an employer with PAYE. So if you're a freelancer with no other job and your bill is over £1,000, you can bet you'll be in the payments on account system.
All right, theory is one thing, but seeing it with actual numbers, that's what really makes it all click. So let's do the maths. We're going to walk through a really simple, real-life example to see exactly how this plays out.
Okay, let's meet Chloe. She's a freelance graphic designer based in London. She's been having a really successful year and her income is on the up, which is absolutely fantastic news. But as we're about to see, that success is exactly what can lead to a surprise tax bill if you're not ready for it.
So here's a quick snapshot of Chloe's tax journey. For the 2024/25 tax year, her final tax bill worked out to be £8,000. Now, this is a super important number because it's the figure HMRC is going to use to estimate her bill for the next year. Then, in the 2025/26 tax year, she has a brilliant year and her final tax bill jumps up to £10,000. Now, let's see how these two numbers play together.
Right, so HMRC looks at Chloe's £8,000 bill from the previous year and basically says, okay, we'll assume you're going to owe about the same for the 2025/26 tax year. They then ask her to pay this in two equal chunks. Her first payment on account is £4,000 due on the 31st of January 2026. Her second is for another £4,000 due on the 31st of July 2026. So during the year 2026, she pays a total of £8,000 in advance towards her 2025/26 tax bill. So far, so good, right?
But here's the million-dollar question. Well, the £10,000 question. What does Chloe actually owe when she files her return for that fantastic 2025-26 tax year? Remember, her actual bill wasn't the £8,000 they estimated, it was £10,000. This is where the balancing act comes in.
And here we go, this slide just brilliantly illustrates the whole concept. The final calculation is actually pretty simple. Her real tax due for the year was £10,000. We just subtract the advance payments on account she's already made, which was £8,000, and that leaves a shortfall of £2,000. That figure, right there, that is her balancing payment. It's the cash needed to settle up for the 2025-26 tax year.
Okay, please stay with me, because this is the single most important part of this whole thing. This is where the January surprise comes from. On the 31st of January 2027, Chloe doesn't just owe that £2,000 balancing payment to close out the last tax year. Oh no, she also has to pay her first payment on account for the next tax year. And what's that based on? Her most recent bill, that $10,001. So her first POA is half of that, which is £5,000. So her total bill on January 31st is the £2,000 balancing payment plus the £5,000 first POA. That is a whopping £7,000. That is the cash flow tsunami that catches so many people out.
Now, understanding the bill is one thing, but not being able to pay it is another thing entirely. The consequences for missing that January 31st deadline can be pretty severe, so it's absolutely vital to understand the penalties and pitfalls. Let's talk about the real cost of delay.
HMRC's penalties for paying late, well, they escalate, and they escalate quickly. If you're 30 days late with your payment, you get hit with a 5% penalty on whatever is outstanding. Still haven't paid after 6 months? That's another 5% penalty. And if it's still unpaid after a full 12 months, you guessed it, another 5% gets added on. And these are on top of daily interest. They stack up alarmingly fast.
And speaking of interest, on top of those fixed penalties, HMRC charges daily interest on any tax you pay late. And as we head into 2026, that interest rate is a painful 8.75%. This is not a small amount. It's a huge extra cost, making it one of the most expensive ways to borrow money, period. The message from HMRC is pretty clear. Pay on time.
Okay, that was the scary part, I promise. But the whole point of this guide is to give you the tools to avoid that situation completely. Let's switch gears and talk about positive, proactive solutions. With just a little bit of smart planning, you can completely dodge the January surprise and stay in the driver's seat of your own finances.
Here is your smart tax checklist. First, and this is a game changer, file early. Get it done in the summer. That gives you 6 months to plan. Second, the golden rule. Open a separate savings account and, without fail, transfer a percentage of every single invoice you're paid into it. 25 to 30% is a safe bet. Third, have a look into HMRC's own budget payment plan. Fourth, if your income takes a dive compared to last year, don't keep overpaying. You can officially apply to HMRC to reduce your payments on account. And finally, and this is the most important tip of all, if you know you're going to struggle to pay, call HMRC before the deadline. They are so much more likely to help you with a time-to-pay arrangement if you're upfront about it.
So there we have it. We've demystified the jargon, we've walked through a real example, and we've got a checklist for success. The theme running through all of this is taking control. Tax isn't just something that happens to you. It's something you can absolutely manage with the right knowledge and the right habits.
Now, just before we wrap up, a very quick and important disclaimer. This guide is for general information. Everyone's tax situation is unique and can be complex, so please don't rely on this as a substitute for professional advice that's tailored specifically to you.
So the crucial takeaway is this. Understanding the system is the first step, but the absolute smartest thing you can do is get expert advice for your specific situation. The team at My Tax Accountant are ready and waiting to help. You can call them on 0208 570 8531, or you can drop them an email at info@mytaxaccountant.co.uk. For a really detailed read on this topic, check out their excellent blog post. The link is down in the description. And hey, if you found this guide helpful, why not subscribe for more simple guides to tricky tax topics? Thank you so much for watching, and we'll see you next time.